Hey there, hope you're doing well today. Was able to get outside a little bit. In Utah today, it's a beautiful fall day, nice in the 70s. We don't get a lot more days like this, and by next week it's supposed to be highs in the 30s and lows obviously lower than that. So it's going to get cold. So get outside and enjoy this weather while we can. Anyway, I've gotten a lot of questions about PPP loans, about accounting for them, the tax side for them, and just how that all works. And so basically the way it's working is the general rule is when debt is forgiven, the tax law says that that is taxable. So whenever you're forgiven of debt, then it becomes taxable income. However, when the CARES Act was passed, it specifically said in there that the forgiveness of the PPP loan would not be taxable, would not be counted as gross income anyway. So the IRS came out and says, okay, well that's fine. We won't recognize it as income in the traditional sense when it gets forgiven. However, when the any expenses that are paid with PPP funds are not deductible. So that means if you get a PPP loan of $100,000, you then spend that $100,000 on payroll, you cannot deduct that payroll on your books. It has to, any expense that you've expended there has to be, you can't deduct it basically. It's a non-deductible expense, which effectively makes it income for you. So, let's take an example of somebody who had no income, where the coronavirus has shut them down. They had zero income, zero customers, nothing coming in, and then they had a $100,000 PPP loan that they paid for payroll, right? So their books would show zero income and an expense of $100,000 for payroll. And then when that loan gets forgiven, rather than recognizing it as income, you basically have to offset that expense and bring that expense to zero. So in that instance, the books would show net income of zero because they couldn't write off that expense. Let's take an example of a business owner that made $250,000. So their gross income is $250,000. They then had a PPP loan of $100,000 that they spent on payroll. So they would have $250,000 of income, $150,000 payroll expense. And so $100,000 payroll. So double check that. So $250,000 income, $100,000 payroll, $150,000 of net income. Now that they cannot write off that PPP loan, the payroll that was paid by the PPP loan, they effectively lose that $100,000 expense and get taxed on $250,000 of gross income that's on their books, which effectively makes that PPP loan taxable to them. So that's something to watch out for on your books and on your taxes. And so the accounting side of that is when you write off those loans, when you get those loans off the books, the other side is to offset your expenses that were used by those, and then that will keep your accounting in harmony. It'll keep everything balanced and everything working, with the huge downside of now being taxed on that PPP loan money. That's the way it currently works, unless Congress makes some kind of change here soon. That's the way it's going to play out for taxes next year. So definitely something to be paying attention to and to be making sure that your clients understand and are planning for. So I hope that was informative and valuable, and hope you have a great day.